Diagnostic stocks have corrected sharply over the past few months, with stocks down anywhere between 40 to over 50% from their 52-week highs. And this is reflected in the valuations as well, which have halved from their peaks over the past 1 year. Today, these diagnostic companies are seeing a fresh bout of selling, with the likes of Dr. Lal's Thyrocare at fresh 52-week lows and the likes of Metropolis and Vijaya Diagnostics close to those levels as well. Now, the reason for this fresh bout of selling is the fear of disruptive pricing emerging in the diagnostic industry. For example, Tata-owned Tata 1mg has published an ad indicating they are offering popular lab tests for consumers at just 100 rupees as they enter the Bengaluru market. They are offering thyroid, lipid, liver function, diabetes screen testing at 100 rupees versus anywhere between 500 to over 650 rupees earlier. While today is fears of disruptive pricing, stocks have corrected over the past 1 year due to rapidly rising competition. While realizations have remained flat for the past 5 years, in the past 2 years, the sector appeal from COVID-19 testing and low entry barriers saw a lot of sudden and fresh investments in the diagnostic space, with many bigger and smaller companies entering, from the likes of pharma company Lupin and Mankind Pharma, entering diagnostics, to hospital chains such as Apollo, Max, Fortis, Aster DM, increasing investments. We also saw omni-channel companies such as PharmEasy increasing their foothold by acquiring Thyrocare, and brick-and-mortar established diagnostic companies consolidating their foothold, such as Dr. Lal's acquiring Suburban and Metropolis acquiring High-Tech Ganeshan. This competition is resulting in lower pricing power, which is expected to reflect in earnings and especially margins. For example, Dr. Lal's Q3 margins were at 22% versus estimates of 28%, impacted due to one-offs, but nonetheless, Metropolis margins at 25 to 26% versus estimates of 29 and 30%, and Thyrocare margins in Q4 were the lowest since Q1 FY21. In fact, Edelweiss, which placed Thyrocare's stock under review, has pointed out in their note that the company may not be able to reduce prices further. The industry remains competitive and susceptible to aggressive pricing. Also says that investments could keep margins compressed in the near term. Lastly, let's leave you with some bear case and some bull case assumptions for diagnostic companies. On the bear case, expect year-on-year numbers to be impacted as the one-off impact of COVID-19 wears off and companies adjust to a new normal. Moderation in earnings could be expected due to higher pricing pressure and disruptive pricing for the industry. More so, the pressure is higher for pure play diagnostic companies as they do not have any diversified revenue, say such as pharma companies or hospitals. Lastly, the bull case. Analysts point out that 80 to 85% of the market is unorganized, hence enough space for all players to grow. They also point out that disruptive pricing is unlikely to stay, as eventually the quality of the tests will matter, which is from factors such as investments in better technology, high quality technical personnel and more collection centers. Lastly, expect further consolidation to streamline the industry. But are we going to see heady margins and even headier valuations in the near term? Unlikely, say experts.